In order to consider the viewing of this video as structured CPD, you must complete the reflective statement to demonstrate what you've learned and its relevance to you. Hello and welcome to Masterclass with me, Mark Colgate. In this programme, it's the outlook for UK equities. Are they cheap, fair value or expensive? To discuss that, I'm joined by three leading experts in their field. Let's meet them. They are Paul Mumford, Manager of Cavendish Opportunities, Steve Davies, Manager of the Jupiter UK Growth Fund, and Alastair Mundy, Manager of Investec UK Special Situations. Paul Mumford, I said at the start, are UK equities cheap, good value or expensive? What are they?
Exceptionally cheap in terms of the market, in terms of various sectors and in terms of individual stocks. So yeah, you know, great. Very attractive. Well,
that's a sort of stock picking answer, but is there plenty in there that's exceptionally expensive?
Expensive, there are a few stocks. There always are stocks that are expensive, but yeah, but I mean generally I think it's great. Yesterday I was able to add to 13 stocks in the opportunities portfolio, which is almost unheard of, because they were cheap, and equally I've added 2 or 3 new stocks over the last couple of months, so yeah, I'd love it to bits.
Okay, cheap market, Steve Davies.
I think we've had 2 very explosive years. So some of the really deep recovery stories have kind of done their stuff. There's still a few out there, but it's more selective. We're sort of moving more towards what we regard as growth stocks, things that can give us 10 to 15% earnings growth on a consistent basis, and we still find that very attractive relative to lots of other asset classes.
So you're seeing lots of opportunity, or is that opportunity range just narrowing down a little bit now?
It's definitely narrower than 2 years ago, but we only have 30 or 35 holdings in our fund, so we don't have any trouble finding those.
Alastair Mundy, you've got a contrarian approach, very value-based. Is there lots of value out there?
Well, we don't think there is. We think we've had a good run over 5 years, and the market's been very good. There was a lot of value then. We just think, even though we're not looking for a lot of stocks, we're really pushed at the moment for interesting opportunities.
Okay, and we talk about how attractive the UK equity market is against itself, but how attractive is it against other asset classes like fixed income? Is it the best of a bad lot, if nothing else?
Well, it is, but is that good enough? If you're the most attractive of the ugly sisters, is that going to get you a date? I'm not sure. Yeah, it's clearly a plan by the central banks to keep interest rates down, to make bonds unattractive and therefore make equities look reasonably attractive. I'm not always prepared to be bullied, or I'm never prepared to be bullied by central bankers to sort of rule my asset allocation or make me bullish or bearish. I don't think that's right.
So if it's ultimately though, do you have to pick the best looking ugly person in the room, or is there something else you can do at the dance?
Well, I think you've got a bit of flexibility with all the funds we manage. We can have a certain amount of cash. We can hold 20% of the funds in cash. So that gives you a reasonable amount of flexibility.
Okay. Just to get a sense of that, where are you with UK Special Situations today on the cash?
We're about 10% in cash. Yeah.
Okay. And is that pretty high for that fund?
It's reasonably high for us. Yeah. We don't worry about always being fully invested like some fund managers do. But this is the higher end of our range. We also hold some international stocks as well. So we've only just got 80% in UK equities.
And Paul, coming back to this point that Steve and Alastair both made, that there have been 2 fabulous, maybe you could argue 5 great years for UK equities. Why are you so bullish that the market's still so cheap? What is it about the valuations?
Well, in terms of sort of figures, the FTSE and the all share are sort of selling at about 14 times earnings. The long-term average is about 16 times. I think at some stage it's going to be up to 20 times earnings, which is a 5% earnings yield. The earnings yield at the moment is 7% compared to gilts, where you've got sort of 3% and your capital value is being eroded. I think equities are absolutely a marvellous investment. Now, having said this, I think it could take 10 or 20 years to get to that sort of rating. But on the other hand, I think in the meantime, it's a very attractive market. And I've got 3 funds: my AIM fund, my Select fund, which is a large cap fund, and my Opportunities fund, which is smaller and recovery situations. I've got 70 stocks in each of them, and there's not much of an overlap, and I've got some great stocks there that are actually going to do the business. I mean, looking at some of the sort of results that you see, or broker comments, somebody will say that a company is coming out with on a PE of 14, 16 times and it looks expensive. Well, does it? When you've got dividend growth, you've got a decent yield, strong balance sheets, and now we've got takeover activity coming into the market. In addition to this, we've got this weight of money argument. Now the weight of money argument's a really good one following the budget. Now the budget actually made some material changes in the pensions, as we all know. One of the most important things is that we don't have to encash our pensions when we get to the age of 75. So consequently, people in the past might have been having a very cautious approach as they approach that age. Nowadays, they can probably have a slightly more aggressive approach on the basis if the market takes a dip, then they can run on beyond that sort of period. Equally, SIPs are quite attractive because you can actually get your money out of them. The ISA allowance is going up the whole time, another weight of money. Pension funds very heavily still in bonds, don't really appreciate the attractions of equities. And I just think it's a very compelling long-term argument.
So in a nutshell, if taking that on, I don't want to sort of twist your argument too far, Paul, but Steve, if there are more people who should be holders of equities for longer, should the price of equities be higher than we're used to?
Well, possibly. I mean, the other point about the recent run is that we'd had 10 pretty lousy years before that. So it's all about the time horizon that you think about these things. Fundamentally, I don't think equities are overvalued at all, but I think we've had a big re-rating in the last couple of years, and the performance from here is going to be much more driven by earnings growth than by the valuations on stocks going up dramatically from here.
But Paul, you're still in the camp then that actually sentiment a positive sentiment can push these up as much as earnings figures coming through?
Well, not necessarily, but I do think there are cheap sectors as well as cheap stocks. I tend to also take a counter-cyclical approach, so I'm buying sectors that people don't like, and I mean in the opportunities fund I'm now out of the house building sector because it's actually done the business for me, but I'm in other sectors which are equally showing good sort of recovery prospects. The sort of aerospace defence sector, oil and gas sector, mining sector. A few retail shares are quite cheap. There's lots of stocks around the place. It's just a great market,
Okay. Well, I want to come on to stocks and sectors in a minute. But just before I do, Steve, what you're talking there about, obviously been a couple of good years for the UK equity markets. How long do earnings need to come through for before the market can have another leg up?
Let me flip it around. I think if the earnings don't come through, then the market won't get another leg up. Right. That's the way we think about it. That if we get a re-rating, and I can see some of Paul's arguments, that's sort of icing on the cake. But the sort of real momentum driver in this phase of the market is earnings coming through rather than a big re-rating of those profits.
And what's the story so far? I mean, we're end of April.
You've got to say it's mixed. I think what we're still seeing is quite a big divergence between those companies with a UK domestic focus, where by and large the momentum of earnings is pretty good. Those that are more global, more exposed to emerging markets, are struggling, and also because the pound's been so strong, the value of overseas earnings in sterling terms is being diminished as well. So mixed and very varied between domestic and international.
Alastair, are you favouring domestic or international?
We don't really look at it like that. We're very counter-cyclical and contrarian like Paul, so we tend to only focus on the out of favour stocks. I think going back to I think the weight of money argument is very interesting because I can see both angles of it. But for every buyer, there's got to be a seller. So someone's going to have to be reducing their exposure to equities along the way. And the buyer, perhaps the buyer's happy at one rating, but the buyer won't necessarily keep putting money in at higher and higher ratings. So there's always cash on the sidelines mathematically. For every pound that goes in, a pound comes out. So I think there are pockets of out of favourness, and there certainly seems to be more out of favour now for us than there was, say, a year ago in areas like food retailing, in particular, is having a bad time, as Paul says. The energy stocks and a lot of the large caps, as we know, have been out of favour for many years, while the mid caps had a great run.
Okay, well, I said I wanted to come to stocks and sectors, but there's just one thing to touch on. We've all been sort of calibrated to looking at the upside. What are some of the key risks that are out there in the UK equity market? So what do we just got to be aware of?
So for us, there's two really. Obviously, we're within 12 months of an election now, and it's probably one of the more binary elections we've had from a market point of view for quite a long time. So that would be one. And the second is rising interest rates. We haven't had a move in interest rates for such a long time, we've almost forgotten what it feels like. So over the course of the next 12 months, it feels pretty likely that both US and UK yields are going to be going up. and that's going to pose some challenge for equity markets.
Politics and interest rates. Paul Mumford, what are the risks?
Well, you've got the global risks, obviously associated with all sorts of companies and countries and whatever things that just sort of pop up out of the blue. So, you know, if you get a horrible sort of movement in the European market, the US market, Ukrainian situation gets worse, China, other things you haven't even thought of, you're obviously at risk. And equities are a high risk investment, and that's why I've got sort of 75 stocks in all of my funds, so that I can spread the risk, because you do get stocks going wrong. Even the greatest sort of stories are, you know, go wrong. But I mean, as far as the market's concerned, I'd love it to go down so I can find some more cheap stocks. You know, I loved it in the bear market when you could pick up really sort of cheap stocks that other people were selling because they were the only stocks that they could possibly sell.
Okay, so that's the third one, sort of just the global outlook. Alastair, anything to add to that?
The main risk is central bankers continue to make up policy on the hoof, and you know, as they go along. And they had one policy to save the world in 2009. It worked for them, and they continue with the same policy even though the world's been saved. And we worry about the unintended consequences of their sort of new policies, newfangled monetary policy. And as we've never been here before, I'm not clever enough to know what those unintended consequences could be. But you know, I think they could range from anything from deflation to hyperinflation to recession, depression, currency crisis. You know, you name it. I think the odds are still very high, because I still think we're in the middle of a global financial crisis. You know, debt remains pretty close to where it was in 2008. So I think debt's just been moved around. It hasn't vanished in any way, and I think that debt could still have a very long-term effect on a lot of different areas.
Okay, well, those are some of the risks. Let's move on to stocks and sectors. If you've just joined us, we are debating the outlook for the UK equity market. You've heard a lot about the macro there, but we're now going to look at some of the stock opportunities and sectors that our fund managers are looking at. Well, I guess if I could pick on something that's really in the news at the moment, which is the whole issue of AstraZeneca potentially being taken over by Pfizer. Is anybody on the panel who's got AstraZeneca? No? Could I ask, why not?
It's a good question. That's what we've been asking ourselves. We've had Glaxo. We just thought AstraZeneca's pipeline was pretty close to zero, and therefore we thought we were effectively being asked to pay a lot for a very large biotech company. Time will tell whether their pipeline was better than perhaps all of us thought, and the pharmaceutical analysts themselves thought. So we thought they were up against it in terms of their earnings were going to be falling over the next 4 or 5 years. That was going to put the dividend in danger, and therefore we just didn't see a great recovery story there.
I've got two problems with AstraZeneca. First of all, I won't triple or quadruple my money on it. I wouldn't have done. And secondly, with the large pharmaceutical companies, they've got to find some blockbuster drugs in order to replace the stocks that come off patent. So consequently, I've got a relatively small company, a company called Alliance Pharma, that buys second-hand drugs from big pharma that have been going for about 30 years. The drugs are relatively small in terms of the large pharmaceutical companies, but they can actually not spend a lot of marketing on it and make a fair amount of money out of the drugs, and they don't have any R&D expenses, nor do they have any particular problem of having to replace products.
Just so I understand the business, but are those drugs that have come off patent, or
no, they're drugs that, small. I mean, if you've got someone like Reckitt Benckiser that, you know, they've got a drug that's absolutely tiny compared to their sort of total drug portfolio. They're happy to sort of hive it off and get rid of the aggravation, whereas to a smaller company like this, you know, it is quite an important product which gives meaningful profits. And I bought the shares originally at sort of 8p. The price is 33p. Bought them on sort of 10 times earnings, still on 10 times earnings, and you know, a lot of potential over the longer term. You won't get out that, you wouldn't have got that out of AstraZeneca, so hence the reason for not holding it. Risky though.
Okay, well I feel.
Oh yeah, that's why it's only one of the 75 stocks, because those sort of companies could always go belly up, and you know, the AstraZenecas of this world, as we see, have got value to other people.
Well, I don't want to seem like we're giving AstraZeneca a shoeing, but Steve, you didn't hold it either. What's the sort of? I mean,
two things
you're not
I'd
keen
say.
on Pharma's full stop.
Well, it's not that we're not keen on it. We just don't think we're very good at it. I think to make fundamentally consistent returns out of pharma, you need to be quite good at predicting what's going to get through the pipeline and what's not. And we think that's a very hard thing to do, even for the people who run the companies, let alone for generalists like us. The other point I make is that, as I said earlier, we run a pretty concentrated fund. We're picking 30 out of a universe of 350 or so. We've got to accept that there'll be one or two that do quite well that aren't in our portfolio.
So, Alastair, if your colleague or a colleague off the US equities desk said, Alastair, this British company, I've got Pfizer, what should I do? Would you sort of say, tell them to vote against it?
Well, it's interesting. The history of large pharmaceutical mergers is that they become less efficient the larger they get. It's as straightforward as that. They seem to be very good at closing R&D areas and cutting costs, but there's not a great record of drug innovation as a result of that. I assume sort of PhDs who find a cure for cancer don't like sort of champions of industry coming in and sacking half their mates, and they lose a bit of motivation, etc. on the way.
Okay, well, I was wondering if we could move from sort of healthcare to the other end of the spectrum, which is the tobacco sector. I was just to get your thoughts. Paul, if I come to you first, but for years we've had sort of, cigarettes bad, and now it's the world of e-cigarettes.
The tobacco sector, I can't be fagged as a sort of joke, but I haven't held. I think the last time I held a tobacco share was when I was in mainly larger companies in Opportunities Fund back in 1993. I had a holding in BATS, and I did reasonably well out of it. Got out of it, far too soon. Always felt a little bit nervous about, the sort of situation in the background. Instead of BATS, I've got a holding in a company called Consort Medical that is actually producing the device that BATS is bringing out for the electric cigarettes, and Consort Medical will actually be producing the system. They've got a 30 million line going into place, and if it doesn't work, then they get the full refund. But from BAT's point of view, they want to get an electric cigarette which is approved by the health authorities, so that there's less danger of health problems, and so consequently that could be a really big stock. But to Consort Medical, that could be a great story over the next sort of 5 or 6 years, whereas to BATS, a good story still.
Sounds like we're going back to the 50s where doctors are advertising cigarettes. It sounds far, but it's good. But joking aside, there's this whole e-cigarette thing. Does that change your idea of what a tobacco company is and what it could be, Steve?
No, I share Paul's enthusiasm for Consort Medical. It's one we hold as well. I think BATS remains an excellent investment, and e-cigarettes had the potential to be quite disruptive, but I think, unlike if you go back to the music companies 10, 15 years ago, the tobacco companies have embraced the challenge of e-cigarettes a bit more quickly and readily than some of the music companies did. And the latest data is kind of showing that people are using e-cigarettes alongside cigarettes, using it in places where you're not allowed to smoke. So at the moment, there's no evidence to suggest it's going to massively disrupt the market. And BATS as a standalone business, going back to this point about growth stocks, you get a great dividend yield out of it. It churns out high single-digit earnings growth year in, year out, because it's got so much pricing power. This year is going to be tough for them because it's got a big emerging market exposure, so that's a bit of a headwind. But we've held it for a long time, and we'll be looking for chances to add to it.
And you'd mentioned earlier that overseas earnings, the rest of the world's slowing down a little bit, emerging markets, but fundamentally they still buy their cigarettes regardless of the state of the economy?
Well, and trade up as well. That's the key from a BATS point of view, is that it's their premium brands that is really driving the growth for them. So it's not smoking prevalence that's going up in emerging markets, it's people paying more for the branded side of it.
And as just final thought from you on this whole area of the tobacco
e-cigarettes, because it is still a very small percentage of the market. I can't remember an industry where the share price has reacted quite so early to a potential disruptor, and I think it is very early days. And there are and at times like that you do forget the positives, especially as it's been not a great time for emerging markets generally. There was plenty of reasons for people to sell the shares. I think one other thing, I think there's just general pricing pricing power possibly in cigarettes anyway in emerging markets, because in many countries cigarettes still look relatively cheap opposed to your Big Mac or your pint of milk. So yeah, I think there's plenty that BAT can still do internally to help themselves.
Do you hold any of the tobacco stocks?
We hold BAT, we hold Imperial Tobacco as well. More on the potential for one last big deal in the tobacco sector, rather than it's got a bit left behind in both emerging markets and e-cigarette development teams.
I know that part of your screening process, Alastair, and I hope I get this, if I don't get this right, please correct me, is that you're looking at, you only look to buy stocks that are at least 50% off their highs versus the market. When you get stocks like BAT and Imperial Tobacco, I mean, they go in and out of favour. Does that form part of your sell discipline as well, or if you buy BAT at the right point in the cycle, you can hold it even if the rest of the world then thinks it becomes a hold rather than a buy?
Just to clarify, we're very index aware as investors, so we wouldn't go overweight any stock unless it's fallen at least 50% relative to the index over the last 7 years. So we can hold other stocks at below or at index weightings. And yes, it tends to be so. We tend to buy these stocks when they're friendless, when everyone's got a list of negatives as long as your arm. And yeah, we tend to hopefully sell them on recovery, just as everyone else is the momentum is behind it, and the consensus is getting more positive about the outlook.
Okay. Now, we've had a question in on financials, which we sort of touched on, the global financial crisis, Alastair, you were mentioning. It says, what are the current problems in the banking sector, specifically concerning how the money which has been pumped into banks does not seem to be coming through into the economy? Well, Alastair, you touched on the financial crisis, so could I put that one to you first, and if you give us your view on where you are on banking stocks?
Yeah, I've got a lot of questions and not many answers on financials, so I'm not sure I should be necessarily trying to answer questions like that with great expert analysis. I'm not sure many people can. It's very interesting. Where has the money gone? Why hasn't it come through yet? Perhaps it's delayed, perhaps we're about to see it, perhaps the money's gone through into financial assets rather than the price of a pint of milk and a loaf of bread. So perhaps there's been inflation elsewhere.
You hold RBS and HSBC. What are they doing with it?
I think one of the great things about the way I manage a fund is that you are allowed contradictions on a portfolio, and if you don't have contradictions, you're in danger of having a one-way bet on some themes. And I think Royal Bank is interesting or intriguing because it is so friendless. Everything. If you wanted to create a less attractive investment, I think you'd struggle. This is a company that's effectively been run by the government, where the previous chief executive left, where they've because of that, where they've massively restructured at the moment, where there's no dividend, where they're possibly they've got capital problems at the moment, and therefore there is no good reason for a huge amount of investors to invest in it. On the other hand, I still think UK retail banking is an oligopolistic business which is very, very attractive. Most of us as customers, and I include me in that statement, are either sort of naive, ignorant or inert. We let banks ineffectively take advantage of us, and I think retail banks still have that. So I think Royal Bank has got an opportunity to get to the promised land if it can restructure, and the discount the shares stand at the moment is that restructuring discount. I think the promised land is attractive, as the Lloyds Bank re-rating has shown. So I think perhaps there is a story for Royal. There's a story for every share, a buy and sell story for every single share.
See, on a value-based strategy, do you think the management's up to getting it to the promised land?
Yeah, well, there's new management. They've got a good track record from Australia. I think they there's no reason why it couldn't be restructured. It was the biggest bank in the world 10 years ago. They've obviously been fighting a fire for the best part of that 10 years. That must made it harder to deal with the operational day-to-day activities. So we think there's lots of, and they've talked about the extraordinary number of website and IT systems they have. Lots of just simple cost cutting.
Okay, you painted such a bleak picture of RBS. I've kind of assumed that. I know you're a buyer.
A lot of the negatives are discounted.
But given that, Paul, is that a stock you hold? It sounds.
The first time I went into banks was in the '73 crash when I bought Barclays, Midland and National Westminster, and obviously those names have changed. So when we had the last banking crisis, I decided, great time to go into the bank. So I bought Lloyds, RBS and Barclays. I'm actually out of Barclays. I'm in Lloyds and RBS. I haven't got my usual 1.5% in each of these. I've just got 1% in them. In the case of Lloyds, I'm waiting for the next government issuing of shares. In the case of RBS, well, quite frankly, there have been other sort of interesting financial stocks that have come along, and in the financial sector, the problems that we've potentially got on some of the companies on the annuity front because of the pensions has created a good opportunity to buy a couple of shares that have been really sort of whacked back. Brit Insurance, the most recent IPO, which has gone to a decent sized discount. They were issued at a price of 240 a couple of months ago, and they're down to about 212 today, yielding 8%. And of course the other one is Phoenix, where again you've got a yield of sort of 8% and a 40% discount on embedded value. The other bank I actually bought in my large cap fund is Standard Chartered, where again the share price got whacked back on the back of a sort of profit downgrade, and I felt that this was quite a decent sort of opportunity. So happy to hold them at the moment. I agree with the thoughts on RBS and Lloyds, and I think that on the bigger banks, I mean, if things go right with RBS and Lloyds, you're going to at least double your money. If things go wrong, they go bust, well, I'm just losing my 1% of the fund, so what? I've got a lot of other great stocks in the portfolio.
And Steve, I mean, you've got, I think you were saying before the programme, you've got Lloyds and Barclays.
And some RBS, as well. So to us, UK banks is the biggest contrarian value opportunity left in the market after the very strong run that I talked about. And that's partly the recovering health of the UK economy. Part of it's self-help, so the headlines for Barclays today about slimming down their investment bank. In the share price today, you're basically getting Barclays Investment Bank in for nothing. So there's a huge opportunity for management to add some value there. And going back to the question, the more boring these banks become in terms of slow lending following the growth of the UK economy, the more friendly they should become to shareholders. There's a huge amount of dividend potential to be paid out of Lloyds in particular. We think they could be paying as much as 8 or 9p a share against a current share price of 75p. So they're not. We want them to become as boring as possible, utility-like, if you like. And now that they're building up the capital levels to levels the regulators are happier with, that really should be distributable back to shareholders.
I'm not sure we've done very well answering the question, have we? The question was what's happened to the money that's been pumped in, isn't it?
Well, yes, but then you did start by saying you don't know.
Have you guys
I would say I think it's a demand problem now, rather than a supply problem. So for the last 5 years, you've had all the banks deleveraging. So businesses have quite rightly said the supply is not available. But it's only relatively recently the economy started growing. Credit demand always lags the pickup in the economy. And most, if we think about the companies we hold, most of them are generating cash month after month after month. So unless they're actively deciding to do something with that, they don't need to go to the bank for credit. So I think you're seeing it pick up in the mortgage market. You're now seeing business investment levels in the UK start to pick up. So I think it's going to follow through in the course of this year.
Well, I was going to ask, Steve, one of the things that was very interesting you were saying earlier about pharmaceuticals, you said we're not very good at them. We can't work out what's in the pipeline, whether it works, whether it doesn't. So actually, we'd rather take our bets somewhere else. Many people would say the financial system's exactly the same. No one's got a clue quite what people have written and how it's all going to work out. Why do you feel much happier having I mean, you've got a big overweight in financials. Why happy to do that, whereas on farmers, absolutely nothing? I think
it's largely a function of them being so friendless and unloved that the degree of transparency you get from banks these days compared to pre the crisis is night and day different. So back before the crisis, everyone was happy paying 2 times book value for books that turned out to be completely illusory. Now, for a lot of these banks, you're buying them on less than book value. And when I get an annual report through from RBS or HSBC, it's 500, 600 pages of very detailed information. And because we're dealing with these guys on a regular basis, if there's something unbelievably that's not in there, we phone them up and ask them for it. And they are incredibly transparent, and that's partly forced on them by the regulators, but also they need to be much more investor friendly than they were pre-crisis.
As banks, you quite rightly picked us up on the original question. I mean, to what extent, though, are the banks, even today, when the government's saying get out there and lend, are the banks also being told by government, and I guess this is political risk, for God's sake, just shore up your own balance sheet. We don't want the system to come down. So actually, we'll say one thing to the electorate, but we're telling something very different to you as executives.
The regulators, the regulators want to make sure they don't go bust and embarrass them, i.e. the regulators. The government wants them to lend so the economy is doing very well, and perhaps there's a bit of both. But I think your question's interesting on what we actually know generally about any sector. I thought you were going to say 500 to 600 pages of gobbledygook, because the language around banks has changed extraordinarily in 10 years, and a load of acronyms. And I'm not sure what we know about anything, frankly. There's always, every single company we invest in, whether it's a farm, a bank or a retailer, there's an amount of ignorance that goes with our decision making. And I think what you said about valuations is very important. Sometimes at least the valuation gives you some compensation for your ignorance. If you're buying expensive stocks and you're ignorant, that can be a very powerful combination against you.
To what extent? Well, then, given that the information the companies put out, to what extent do you? I mean, obviously you analyse the figures that you can, but also, I mean, if you look at a report and accounts and think, God, it's this corporate bilge, does that put a big cross next to it? Just the way they express themselves, does that make you think, I can't, they're making it difficult for me to find out what's going on here. It ain't, there's got to be, not necessarily there's something wrong, but it just feels...
I think at the extreme, yes, if you're looking at a company, you don't understand its accounting, or, they seem to be making life rather complicated. We're not, I think some investors do look for complexity, thinking perhaps they're the most intelligent people in town, and therefore they've got an intellectual advantage. We're more attracted to simple, easy to understand business that have been around a long time. But we've all got comfort zones, and different comfort zones, I think, as investors, where for whatever reason, and we might have followed the company or industry for a long time. But I think at least you've got to try and understand your circles of competence and not stray too much from them.
I think transparency for us is vital. So we have target prices for everything we own in the fund, and that's based on our own forecasts of what we think these companies can make by way of profits on a 2 or 3 year time horizon. So if we don't think we can forecast that accurately, then the target prices are bilge and they're a waste of time. So for us, anything that resembles, we call them black boxes, where I can't see how a sales line translates into a profit line, I don't want to go anywhere near it. It's not to say that they might not be decent businesses, but I'm not going to see that nasty event coming because I haven't got that visibility.
And how good is your predictive power on where price targets should be in a couple of years? Because you must, if that's an important part of your process, you must step back from it occasionally and think, how good are we?
So what we look for is where we differ massively from what the market thinks, because that's what gives you your margin of error. So we had a really good example a couple of years ago with Dixon's, where everyone thought it was going to go bust, it was going to be the next HMV. The market thought it was going to make about a penny of earnings, so a 12 or 13p share price looked quite appropriate. We did a load of work on it. We saw that people like Comet were going to go bust, and there was a lot of self-help that they could do. And we were getting to a number of somewhere between 3 and 4p. So with that margin of difference, you're effectively buying the shares on 3 or 4 times earnings. It doesn't matter really whether the outcome is 3p or 4p. If you get it vaguely right, you're going to make an awful lot of money. So it's about sort of skewing the odds in our favour as much as possible, and just picking on those situations where we disagree with the market.
A good company and a good investment are sometimes very different things.
Yeah, absolutely, absolutely.
And Paul, just one final thing on financials. You were saying earlier about that this changed the annuity market, more people buying into equities. The flip side, after that announcement came out, a lot of the annuity company share prices absolutely tanked.
Yeah, of course.
Were you a buyer at that point?
No way.
Is there a point where it's a value trap, not value?
What's the point in catching a falling knife? But I took advantage of it by buying, the insurance companies that weren't exposed to the annuity market, where, sentiment had suddenly collapsed. Yeah, I mean, having said that, I did hold Aviva, a little while back, and doubled my money on it, and felt that at that stage, probably Aviva were, on the one hand, sort of looking a little bit less cheap than they were before, and on the other hand, I think I had another great stock to buy, and I had to sort of kick it out of the portfolio. So half of my sell decisions are purely based upon finding great opportunities to buy other stocks.
Great question here. Is anyone investing in the challenger banks such as Metro, Sainsbury's? Steve?
we're certainly going to have a good look at them when we get the chance. And this is partly with the political risk in mind. So we've already seen what Ed Miliband's had to say about what they or may not want to do if they get in as a government. So TSB is probably going to be the next one on the stock. So we'll certainly have a good look at that.
And Paul, one for you. Why did you come out of Barclays?
Well, effectively, I treated Barclays as a little bit of a trading stock. And I was trading it between sort of 260 and £3, and then the share price sort of went up, and then the news sort of progressively didn't get a lot better, and I felt a little bit uncomfortable about Barclays, and felt the other two probably offered a little bit more potential. But more importantly, there were other great stocks in other sectors which I wanted to buy. So, you know, I forgot about Barclays and went charging off into an oil company or something like that.
Well, I was going to say, you purchased, looking at your fact sheet, you purchased Rolls. I mean, I'm not saying this was a direct replacement for Barclays, but you purchased Rolls-Royce after it had a bit of a sort of, its earnings were heading down rather than up.
Great opportunity.
I thought most people sort of said if you're holding a stock and the earnings start going south, you want to get out of there.
No, I mean, Rolls is effectively a great sort of long-term story, and you know, I think the entry level was pretty good, but it is in one of these sort of large cap stocks that I sort of class as a recovery situation in an out of favour sector, and I won't hold Rolls-Royce for ever and a day. You know, if I make my sort of 25–30%, I could easily be moving on to the next one.
And just, we saw Sainsbury's there mentioned vis-a-vis banks. Alastair, you'd mentioned the food retail sector earlier. Is financial services going to be a great growth area for retail, or?
Well, they've been in it quite a long time, haven't they? And they haven't, you know, it's done all right. You know, I think Tesco's has probably done better than the others at it. It's very, very hard to break into UK retail banking. That's what history tells you. You know, we are as customers more likely to change our partners than our banks historically, and it's very easy to change a bank now, and we still don't do it. So it's going to be interesting to see if these challenger banks, even with political help, can really break into that market. History suggests it's going to be pretty tough for them.
Particularly because it's a free product.
Yeah.
You know, you get huge amounts of attention being paid to switching in utilities and telcos and this kind of thing, where people are overtly paying for it. But Alastair's right, the switching data, even now, I mean, I've done it recently, and it's not difficult to do. And yet, which I think is kind of telling you something. I think the other point is that there are 6 or 7 decent sized banks in the UK already. Which is just as many as you've got in quite a few markets already. So I think making switching easier is massively important. Making costs and charges more transparent is the other thing that the regulators should be doing. And then sometimes you just have to let the customers decide.
I'm not going to ask you how many times you've been married, Steve, if you just told us about that bank swap. But within, just on food retail though, I mean, there's a sort of the big handful of the food retailers, the Tesco's, the Morrisons and so forth. Something like Tesco, it's been a success for so long. I mean, over decades it's been growing, everyone's been lionising it, then all of a sudden it turns like that. Where is it? What happened? Where is it now? Are you a buyer?
I think it's an intriguing story. I don't think it's gone off the boil over a number of years. I think they did a lot. They thought they could put their flag in the sand in a number of different countries. Perhaps they got a bit arrogant and complacent in the UK, and perhaps everyone else lifted their game. At the same time, we've always been a bit concerned that Tesco is full of Tesco people. They've never taken a lot of fresh blood. We've been concerned about some of their accounting as well. But the recent sell-off and the concerns about the growth of discount retailers and the likes of Waitrose, I think perhaps it's a little bit overdone. You know, I know those other stores do offer something, but given its market position, Tesco isn't going to die without a decent fight. And it might take a change of management, but you know, we think Tesco have got enough flexibility within their business to win back some market share.
Worth putting your unit holders' money into at the moment?
Yes, we have, but we've got about 2.5%, a bit more in it at the moment. We just think you know, that we wouldn't be surprised if there's further bad news and further share price falls, so we'd be eager to buy some more on the way down.
Okay. Steve, you want to come in?
Still too early. We've avoided the food retail sector for an awfully long time. There's been far too much capacity being put down. It's the classic prisoner's dilemma that if I open a new store, then I'm gaining a bit of your market share, but then you go and do it back to me, and there's just too much space. And the problem for us now is that we can see the margins are coming down in this sector. but we really don't know how far they're going to fall, and I think the chances of them bounce back up again are actually quite low. So I can see a scenario where Tesco's margin falls from maybe 5% to 3%, which, if you thought there was a good chance of it getting back up to 5, would make for a really good recovery opportunity. But my fear is that 3 is just where it sticks at going forward.
Paul, what's your take on that sector?
I've been in and out of them in Opportunities Fund. I'm out at the moment, so they're probably on the substitute bench behind a lot of other players. The way I'm playing that sector is by McColl's, the recent IPO, which has equally gone to a discount. Convenience stores, they've just got £5 million from the post office in order to put post office counters in some of the stores. Reasonable portfolio, good management, and a growth company in that area of the marketplace. And again, I've only got 1.5%, so if it goes wrong, then I'm not losing a lot of money in the portfolio.
You've talked a lot today, Paul, about stocks that you've been in and out of. What have you got that's a good long-term hold?
Difficult to say, because if we go back to 1999, when the market reached its peak and the FTSE was 6,900, and I think my share price has gone up from something like £3.40 to £10.50, and I've only got one share left in the portfolio from that stage. In 2007, when we last reached its peak, where the index was probably around about the current level, my share price has gone up to something like £5.40, and it's doubled since then, and I've only got 26 shares left in the portfolio. So it does sort of forever sort of change, and sectors change. The property sector, I'm reasonably overweight in that at the moment. Oil and gas sector, reasonably well overweight. There's some really good stocks, and some of those, I mean, you don't really want to look back and say, what have you held for a long time? What you want to do is say, look forward. Let's see what we can make money out of over the next 5 or 10 years, and this is where the excitement lies. And I say particularly in the oil and gas sector, because we had some decent figures from Shell today, which have gone up about 4%. We've had a takeover of Heritage, which are up 20% today, but they've been up considerably more since December. And we've had a great deal from Faro Petroleum, which I hold, where they bought production assets for 35 million. They're getting they'll having to pay 26 million because the start date is in January of this year, and they'll be getting their money back in a year and a half through the earnings that it's bought through this acquisition. Now, for a company with a market cap of 300 million, that's pretty good. Plus, they've got exploration prospects on top of that. One of the larger license holders in the Norwegian part of the North Sea, where you get 80% of the drilling costs back. And great, but there again you've got other companies in the same sector. If I hold Ithaca, which is another oil and gas company, for the next 5 years, selling at 1.5 times cash flow at the moment, great production coming onto field onto stream at the end of the year, and its market capitalisation is covered by tax losses. Great sort of situations there are around. So look forward. Don't look back on what. Well, but I can tell you a stock I've held since 1995 if you want me to.
Just give us the next. We're almost out of time. It's
a company called MS International, which I bought at 22p. They're £2. I bought them on sort of 10 times earnings, on 10 times earnings. Still hold them, cash in the balance sheet, doing reasonably well, etc. But yeah, okay, that's my time.
Okay, that's your time, Paul. Thank you very much for that. But I think this point about looking forward, we do have to bring it to close. So you've pointed at lots of opportunities in the oil and gas sector for looking out on a 5-10 year view. Steve, again, looking forward 5 to 10 years, where will be, as you're looking at the markets, whether it's sector stocks,
5 to 10 years, I think the biggest theme, if you like, on that kind of time horizon is consumption in the emerging markets. It's going to have a tough year this year because there's an economic slowdown, but this story that we're all very familiar with about a growing middle class and more aspirational purchasing habits, there are relatively few Western brands that can benefit from that. So that's on a 5 to 10 year view, that would be the big theme for me.
Okay. Alastair, final thought.
I don't think we really do themes in that way. We're very much from sort of bottom up, distressed equities, large cap, mid cap distressed equities, and over 5-10 years, lots of distressed equities come and see you. So we'll get lots of chances in lots of different sectors.
Gentlemen, we have to leave it there. Thank you very much for watching and for sending in all your questions. Please do stay tuned because there's some information in a moment about how you can use this as part of your structured CPD. Just remains for me to thank our panel. They were Paul Mumford, Steve Davies and Alastair Mundy. Gentlemen, thank you all very much. Thank you for watching, and from all of us here, goodbye for now. In order to consider the viewing of this video as structured CPD, you must complete the reflective statement to demonstrate what you've learned and its relevance to you. Among the topics covered by this masterclass are the current valuation of the UK equity market, the international nature of earnings from UK companies, and the outlook for financial stocks. Please now complete the reflective statement to validate your CPD.